Hello, everyone. Gonna get started here. This is I think our a few weeks into it. We're just doing quick videos on commercial real estate and the different roles and responsibilities involved. So yeah, today we're gonna be continuing our asset management series. So and also kind of link the roles with asset management and acquisitions and see where teammates can kind of collaborate and get a lot more efficiency within projects. So yeah, so I'll kind of like inform you about like both sides a little bit and see like where teams can kind of mesh well together. So yeah, so let's get started. So asset management, what are you primarily focused on? You're primarily focused on managing the asset to its most efficiency. You want to see good performance from the property, whether that be occupancy, the overall property condition, and also the tenants' reviews, and also the relationships that you keep with them too. So that's kind of what you're focused on within the property, and also meeting with the property management team that's on site and managing the property, doing like the leases and overall just making sure that the property's up to date, right? So it's kind of a weekly obligation towards like one property, and making things make sure that they're going smoothly, basically. So let me talk through kind of the financing aspect. So this is kind of going to be the theme for today's video, is just like financing with asset management. So it's it's kind of a step-by-step process that you have to go through for financing. First of all, like getting qualified buyer lender, and making sure that you have like kind of all of the terms kind of broken down, right? So there's a lot of terms within the financing world. So we're just gonna go through some key ones, and then also inform you about some other special terms within the financing world. So yeah, so let me hop right in. Let me get to the point. So acquisitions in general is going to source the deals, underwrite the deals, and assume financing, whatever, like 5%, 6%, 30-year fixed rate, whatever the initial financing is, they're going to assume that financing, right? So they're also going to be one of the main people involved in actually closing on the deal, closing with the lender, doing like getting the appraisal report done and making sure that the loan is approved. So once that happens, you kind of have, I would say, a period of time where you can decide to refinance. And especially given the current market, you want to make that decision accordingly. So if the market has really high interest rates right now, and you're projecting like down the road 2-3 years from now that they're going to go down, you want to make sure that you have that refinance period ready. And that's also going to be built out into the Excel model as well. So let me share my screen and kind of walk you through the first initial phases of financing. Things that you should be sending to your lender. And a great site that I've kind of came across that kind of shows and gives you a rough term sheet and a quote on different loans involved with commercial real estate. So first off, I think it's really important to just have a basic Excel like loan analysis model. And so that you can pretty much mirror this into the overall master underwriting for the like the return structure and overall cash flows on the property, right? So this loan summary is pretty basic. It kind of just walks through the underwriting summary, pro forma summary, the loan terms involved, the loan metrics, the sources and uses of funds, right? So first off, you're going to have some justification of the value. So that underwritten NOI is going to be something that you want to include into this loan analysis, so that when you go to a lender, you tell them the property that's at play, what the actual NOI with that property is, that they're well informed about the property's pro forma, right? So you want to include the property's pro forma into this. So this is very basic, just has gross potential revenue, netting out like downtime, vacancy, concessions, and other non-revenue units. Then you have other income, which includes ratio utility billing services, retail income, fees, pet fees, parking garage, whatever. Then you have total potential income and subtracting out general vacancy and credit loss. You get down to EGR, which is should be where you get your management fee and your asset management fee from. So you have all of your operating expenses here laid out. And the net operating income is also at the bottom after you net out operating expenses. And then you also have reserves, if any, laid out below that. And so basically you're going to make sure you tell them what the going in cap rate for that property is, whatever it's priced at. You want to make sure that they're well informed about the in-place cap rate and the stabilized value on that property as well. So you're going to want to first off do it a three-step process, like in place, then stabilize, then sale. So essentially, if you are refinancing like within the first year, then you want to tell them that the stabilized value is what you're basing your underwritten value off of, right? So this would be your refinance value that you would fund the loan off of, right? And that's also based on the cap rate growth. That's the spread between the in-place and the sale period. So it's like 5%, or sorry, 0.05% per year. But yeah, so this kind of shows them a quick overview of the property, and it also tells them what type of loan that they're going to acquire, whether it's DSCR, LTV, LTC, or debt yield as well. So yeah, so let me walk through each one of those and show you what they're actually meaning. So here you have the net operating income derived, then you have the loan amount, which is also on a separate page. You have the loan term, the interest only periods, the amortization, the interest rate, the balloon balance if you are doing a balloon loan, and then the average life of the loan. The average life of the loan is essentially kind of saying like what is it going to take to break even, I would say, on your loan. So that's when you start realizing gains from the property's cash flows, and you start to pretty much get cash flow positive after that. So it's essentially saying you can pay off the remaining balance of the loan and you're still kind of cash flow positive after that. So yeah, so the loan metrics involved here, you have, these are just your payments, your P&I, principal and interest. Then you have amortization, DSCR. So DSCR is essentially your NOI divided by your debt service monthly payment, or sorry, yearly payment, that is. And that's either on an amortized way or an interest only way. So interest only is obviously going to be a lot higher because you're only paying the interest portion of that debt service. So debt yield next is essentially your NOI divided by your total loan amount. So this essentially tells the lender that how many like years is it going to take for the NOI to cumulative NOI to match the overall funding amount for the loan, right? So it's at 8.94% right now. Roughly, that would take like 11 or so years to get it up to that loan balance. So yeah, and then LTV is a loan to value, so 71% there. LTC is loan to cost, so overall project cost, which is noted right here, which is the total uses of funds. So this essentially is purchase price, closing costs, usually a percentage of the purchase price. Broker fees could also be a percentage of the purchase price. Hard and soft costs, any like engineering fees, construction costs, construction management fees, other soft costs involved, those would be included here. So we went over the pro forma. Now let's go to loan terms. So this is where you see whether the loan metrics are met. So the loan sizing is done here. So basically, you have your loan parameters, whatever loan you're trying to acquire. 30 years is usually the general type, either fixed rate or variable, floating or fixed, right? The closing date of the loan, and then the benchmark that you're using to size the interest rate off of, right? So the 10-year US Treasury right now, it's not at 3.83%. We can actually check right here what it's actually at. See here, daily Treasury par rates. There you go. So this is a great site, U.S. Department of Treasury. Tells you what the Treasury yields are at. So currently, as of 12/10, it's at 3.51. So extremely low. So that means it's indicating mortgage rates and debt rates are going down, right? So let me just open up a quick site here and go back to that commercial loan direct. Okay, so we'll get back to that, and then yeah, so you're also going to have a loan fee, origination fee, whatever that percentage is going to be here. The APR is essentially your annual percentage rate. So this is the interest rate plus any types of closing costs that are involved. Basically the total cost associated with the loan's interest, right? So yeah, so closing costs can be anything from the appraisal fee to origination fees to any types of other fees that the lender might tack on. So I always think it's great to just negotiate that up front. Really, I like to just tell them it's just like origination fees and maybe an appraisal report, right? So those two fees like are going to be given. Anything on top of that, you want to try and negotiate. But yeah, here's the proposed loan amount. So this is we're using an LTC test right here. Now LTC is usually going to be for construction loans, not really for your general agency loans from Freddie or Fannie. It's usually going to be just construction loans, but you can try and ask your lender like, hey, we have a really big project going on. We have a lot of costs associated with it. Is it possible to get an LTC loan? Like you can just ask them and just explain what you're trying to accomplish, and maybe they might approve that. So loan of value test, usually it's 70%, LTC it's 70% right now, specifically. Sometimes it's 75 in a lenient market. Right now, debt markets are kind of were expensive, right? I mean, are expensive right now compared to a year ago. So definitely more strict underwriting and more restrictions involved. But the debt yield test is essentially NOI divided by total loan amount. And overall, that's going to give you what type of percentage that you have to meet on top of whatever that test is, right? So 8% is usually the given amount. If you get higher than 8%, that's great. Right now it's 8.94. This is just a hypothetical kind of analysis right now. So you can plug this into an actual property, and whatever loan that you're trying to acquire on that, you can test it out through this model. But yeah, so 2% is, or 2x is the interest only test, and 1.25 is the general DSCR amortizing test that all lenders usually require. So 1.25 is that. Next tab is your refinance analysis. So essentially it's going to be what your projected NOI growth is on a 10-year, whatever your hold period is, basically. So the debt service is going to also be displayed here in the cash flow after debt service. You're going to have a cap rate growth starting in year one. So we started at 6.4, right? So it would be growing at 0.05% per year. And then your net proceeds are essentially whatever valuation that you have, subtracting out the remaining balance and getting your net proceeds. So yeah. And then overall, really what the lender is gonna most likely look at is just the value on your property. So they're gonna be more closely paying attention to this valuation right here. So whatever year by year it's projected to be, they're gonna be eyeing in on this column right here. And then also whatever LTV that they have in mind, and then the loan amount that they have in mind. So they're gonna be closely watching this. Usually refinance rates are based off of DSCR. So you also should look at literally all of these, like this entire refinance assumption, like these columns are really important. So this is based off of debt yield, this is based off of DSCR, this is based off of LTV. So yeah. And another thing to keep in mind is when you do get an appraisal report, it's always key to make sure that that appraisal is where you want it to be at. If it comes back lower than expected, lenders are typically going to finance the lower amount of either the purchase price or the appraisal report, right? So yeah, always just make sure that you're kind of talking with your lender about what the actual funding amount is going to be. Because I would always do it off of purchase price. I think that's the best way to do it, but appraisal reports give you a better idea of the value, and then you can also take the appraisal report and kind of talk with your broker about this and say, hey, where can we meet at this appraised value, so that we don't have too much confusion involved with the financing, right? So yeah. And then here's just your interest rate summary. So for instance, like right now, it was at 3.51, right? The daily rates. Yeah, so 3.51 is what it's at right now. So, I mean, you should probably go back here and just change that number. So 10 years, 3.51. So I probably have to change all of these, honestly, but I also have a link here. It's always good to kind of just link a lot of sources in your Excel just so that you can go back to them, you know? So here's just a quick link to that. So yeah. Okay, so essentially the next thing is also going to be just a sensitivity analysis. So basing off of any type of reduction in NOI, which is basically a risk management point right here, is if the NOI drops significantly somehow for some unforeseen reason, what is the best type of financing we can still obtain with that deduction or reduction, right? So for instance, this 10% reduction in NOI is gonna leave us with getting sub 70% LTV financing. The 10% reduction in NOI is gonna leave us with I would say 41,000 in net proceeds, or refi proceeds, that is. So that kind of shows you the overall sensitivity of that. And the prepayment is really important. So this is going to be when you're going to pay off your initial financing. So this should all kind of be flowing fluidly through. So whatever your payoff date should also be that refinance period where you acquire the new loan. So yeah, so what's happening here is you just have a estimated payoff amount, which is your outstanding balance at prepayment plus the prepayment amount. And then your prepayment amount is either going to be based off of defeasance, sorry, not defeasance, what's it called, yield maintenance, or just like a step down percentage of the balance, right? So yield maintenance is the absolute worst. It's essentially taking the remaining interest payments on that loan and making the borrower pay that upfront, which is ridiculously high. In my opinion, I think it should always be just percentage of the loan. It can be a step down basis, 3 to 1%. And that's kind of the general prepayment method that I like. The remaining term and the spread is also laid out here. So yeah, this is a nice little tab that I have going on here. So oh yeah, this was an acquisition loan, my bad. Oh, I messed it up. What did I do? Let me just undo stuff. There we go. Okay, so this pro forma summary is kind of general to follow along here. And then this is also the lender cash flows. So this is really nice. You can include this for your lender to see the month by month cash flows that they would receive. And then this is just a basic amortization table, which also factors in the interest only periods and the overall month by month cash flows pretty much. So yeah, pretty general to follow along with. And I would always just it doesn't even have to be this extensive. It can just be a basic, like even like a rough tab like this one, plus like just including the pro forma and then the loan terms. Like these 3 tabs is really all you really need. Refinance analysis is just additional. But yeah, so it's a quick loan analysis. So you should do this loan analysis on the acquisition period and also on the refinance period. So yeah, it's really speeds up the lender process and just gets the lender and the investor kind of on the same page as far as the financing assumptions. So yeah. Now Commercial Loan Direct is another great site that I've been kind of looking into. They have apartment loans, commercial real estate loans, the trends. They also have a great learning center as well, which has like some great Excel models as well. Or sorry, just like financial calculators, basic ones. So this is where you can kind of learn all of the different terms involved with financing. Obviously, it's great to kind of have a nice site like this that you can rely on and find also like actual financing. So from this, like you can see what the typical rates and terms are with, let's say, an FHA HUD program loan. And then you can also contact the lender right away and obtain a quote on a loan. So using a site like this is great. It kind of helps to just like clear up the financing because that's always kind of a headache for most people. But yeah, so this is typical kind of a table breakdown of all of the terms involved, the requirements involved, and then the pricing structure and the rate trends right now. So yeah, highly recommend this site. But yeah, so that was a bit on financing. I thought we kind of covered a decent amount just through this table, and then I would just take a look, just browse through this site, Commercial Loan Direct. It's great. You can quickly apply for a loan as well, and then you can talk to a representative right away. So yeah. Overall, asset management really does include the financing portion of like a lot of properties, right? So you should be keeping track of like P&Ls and making sure that the financial statements are in line. So it helps to kind of have all of that sorted out. And then when you're going for refinancing, you have the lender kind of and you on the same page as far as making sure that the property is cash flowing positive and making sure that you're able to cover your debt after the net operating income, right? So yeah, so thank you guys for tuning in today. I also just wanted to mention that for our YouTube series, we're just going to be doing quick videos like this, and then also for our property management, we're also going to be including just a basic overview and kind of like a screening checklist that you can kind of go through if you are hiring third-party property management. So yeah, and then just to wrap up on asset management today. So we went through the financing, right? We went through the weekly meetings that you should be having with your property management team. So another thing would just be the leasing as well. I'll also overview a quick kind of guidance on how to structure leases, the different negotiation points that tenants and landlords can both have, and seeing where you can make sure that either like that process is kind of shored up, you have a nice software that you can utilize to track all of your leases, and overall just see on a month-by-month basis where or what are the more action steps that you can take to improve tenant relations and make sure that the property is leased up properly, right? So oftentimes, like when you are losing tenants due to expiring leases, you will have a period of a few months where it's vacant, and that could be a substantial loss in the cash flows for that year, right? So usually it's kind of a tricky situation where you have that period, and let's say like the next month or two, like you're refinancing, right? Or sorry, the next year or two, you're refinancing, right? So all of those vacancy assumptions and those losses would be reflective on your pro forma that you submit to your lender. So that would not be a good situation. So always just make sure that leases are kind of shored up, and knowing the different terminologies within a lease is really important. So we'll go over that. And then overall, just I would say maintenance requests and vendor relations. That's another thing to talk to property management teams about. And overall, like what can you approve at like the base amount, and then anything above that, I have to thoroughly kind of approve and kind of go through a little in depth. So yeah, I would just say it's a team sport. Commercial real estate is definitely team heavy. You have to have great relations, and making sure that that you're very upfront and honest about what you're trying to accomplish, the KPIs that you're trying to meet, and overall making sure all the documentation and paperwork, financial statements, everything is kind of flowing smoothly. But yeah, so I'm going to wrap it up here. So stay tuned for just more asset management and property management themed videos, and we'll talk soon. And coming up later this week is also syndications, more underwriting, and overall just acquisitions specialty in commercial real estate. So stay tuned for that. Thank you guys for watching.